All right, welcome to this episode of velocitybanking.com. So we're going to start a new series called Velocity Banking in 6 minutes, where I break down all the core concepts as to how to implement the velocity banking strategy, because I've been getting a lot of emails and there's still some confusion about how and what and when all these other stuff. So I'm going to break it down over the series of these videos. So we're going to start today talking about what is velocity banking. We're going to break that down, and then we're going to talk about what is the difference between a loan and a line, because that's the core concept that you have to understand when doing velocity banking, is this concept of loans and the ideas of lines. So what is velocity banking? Let's get right into that. So velocity banking is just a strategy, just like any other strategy, as to how to pay down your loans and debts faster. And out of all the strategies that I've looked at, this is the fastest strategy and the least intrusive to your way of life. So because really you don't have to change a lot. You just have to tweak things, move things around a little bit, and then you can actually implement the strategy. Now, the downfall of this strategy is that you have to be disciplined. If you're not disciplined with how you pay you pay your bills, or what you spend, then the strategy may not work for you. Now, fortunately, our application breaks it all down for you. It breaks down when to pay it, when to pay the bills, what bills to pay, how much to pay, all this other stuff. So it makes implementing the strategy really, really easy. And so if you haven't already done so, make sure you head over to our website, myvelocitybanking.com, sign up for a free account, enter all your information, your income, your debts, your expenses, and then you'll get a breakdown based on the velocity banking strategy as to what to pay, when to pay it, to maximize your payoff time. So that's what velocity banking is. It is a strategy, just like any other strategy. So I always draw an analogy to if you were working out and you want to lose weight or put on weight, or you need a plan of attack. You need a strategy as to what to do each day that you go to the gym, right? So it's the same idea. When you're paying down your debt, you need a strategy of how to actually tackle these debts. Now, what does happen is that most people aren't clear as to what to pay off, when to pay off. And I was in the exact same situation. I had a dad size, some credit cards I wanted to pay off. I have a mortgage I want to pay off, and so it's just getting a strategy down as to what to pay off to optimize your payoff time. So that's what velocity banking is. It's just not a strategy. There's anything magical about it. Anybody out there who tells you that there is some magic to velocity banking, there actually isn't. It's all math. And what we've done is we've made it easy for you to actually implement the strategy. So that's it. So like I said at the beginning of this video, we're going to start a series, velocity banking in 6 minutes. So we're going to break down. I am going to break down all the concepts as to what velocity banking is, how to implement it, and why it is going to help you get out of debt as soon as possible. All right, so let's get right into it. Loans versus lines. So what is the difference between a loan and a line? This is one of the core fundamentals when doing velocity banking. You have to understand how the banks work and how the loans work and then how a line works. So let's break it down. So a loan is pretty much anything that's amortized, right? So that could be your mortgage, that could be your student loan, that could be your car payment. So anything that's amortized, and I'm going to explain amortized in a little bit as well. Anything that's amortized is usually a loan. Now, line is just it's calculated on a simple interest. So you just have a line, for example, a line of credit or a credit card. That's also a line. It's just anything that you only pay for what you use, basically, is how a line works. Now, loans, I talked about amortized before. So amortized is what the banks do, is a way of figuring out how much you pay each month over the course of the loan. So when you go get a mortgage, for example, the bank sits down, they enter it into the formula, and they come out with actual payments, right? So if you went in, got a 25-year mortgage, 4% interest, 200,000, and you wanted $200,000 for the mortgage. The bank enters in all this information, and it magically spits out how much you pay each month. So let's say it's $1,200 a month. So you're now paying $1,200 a month for the course of the 25 years for the amortization period. That's why banks call it the amortization period, because this is how much it's going to take to pay off. That's usually the exact same length as the loan. So here's the thing about loans that the banks really don't tell you, and it's really not known a lot by a lot of people, is that the way they calculate the amortization is not in your best interest. It is in their best interest. Because here's how the amortization works. They take all the interest that you'll pay over this 25 year, and they put all the interest in the front of the actual mortgage. So that's called front loading. So all your interest is paid at the front when you actually start paying the mortgage. Front loaded interest isn't good, because anytime you make a payment, say this $1,200 a month that you're making towards your mortgage, what happens is that almost all that goes towards interest. So you're not even hitting the actual principal, the actual amount that you owe. You're just paying off the interest first. And so that is going to take at least the first half of the mortgage to actually get to the principal. Maybe it might be a little bit less than half, but the point is that all the payments that you're making are not going towards the principal. They're going towards interest. Now that's a bad thing, because, as we'll talk about in other episodes, that another core thing to keep in mind when doing velocity banking is that interest equals time. So the longer it takes you to pay off anything, the more interest you'll pay on it. So one of the core pieces of velocity banking as well is you try to minimize time, because if you minimize the time, you minimize the interest. Now, if you're doing a 25-year loan, that's a lot of interest. And even if you don't get to the principal, you're paying more interest. So what ends up happening when you take out a mortgage, because of the amortization and the way it's amortized and the way that the loans, the payments work, you end up paying like twice, even like 2.5 times what the actual loan was. So basically, you could buy 2 houses for the same price as the amortization, or so for the same period of time. So that's something else about lines and loans. So so we've talked about lines. Lines are not. Sorry, we've talked about loans. So loans are not in your best interest. Lines work pretty much as you would think if you got a line of credit, or if you got a credit card. Lines are just regular interest, right? Just simple interest, and you only pay on what you owe. So it isn't amortized. There's no time span to it. It's just, if you had $5,000 on your credit card, you just pay that interest on that $5,000 that you owe. Once that $5,000 is like paid off, you don't have to make any more payments. Now, banks got also smart with lines. So here's what they do too with lines, and that's why during the velocity banking, we can actually beat the banks at their game. So what they do with the lines of credits now, especially with credit cards, but any lines, that they will give you the minimum payment. So they'll send you a statement. They'll say your minimum payment is $10 a month, for example. Here's the thing: that $10 a month is also a trick. It's a trap, because if you look at the fine print, it will tell you if you just make the minimum payment, it'll probably take you like 100 years to pay off this loan, right? Because they know that most people will just make the minimum payment, so you're incurring interest as well. So a line is better than amortized, but only if you do it right. So again, the whole velocity banking strategy is like set up to help you avoid that trap, and B, to be able to pay off your debts as soon as possible. So that's the difference between a loan and a line: amortized and regular interest, or simple interest, or whichever term it is. But the point is, those are 2 things, and those are key, because during the next videos, we're going to be talking about how to move anything from a line to a loan. Sorry, from a loan to a line, because that's what you're trying to do. Because loans are bad, lines are good. Now, how do we move things from loans to lines? And we're going to get into that in the next few videos in this series. So if you haven't already done so, I'm going to say it again. Make sure you like this video and subscribe to it to get all the rest of the parts of this series. And then also head over to our website, myvelocitybanking.com, and get a free account and learn all about velocity banking. And I will talk to you next time.